The Bank of Canada sits at 2.75% right now, but here's what most people don't know. Most economists and markets are pricing in a 25 basis point cut to 2.50% at the September 17th meeting. But that's not the real story. The real story is what happens after that cut. Because of global tariffs and inflation uncertainty, some analysts think we could see rates drop all the way to 2.00% by the end of 2025. This gap can change mortgage costs and cash flow for investors significantly over months. Take a look at the references in the description. Based on the information provided, here's what they suggest you do if we own properties right now. But there's a catch that could change everything. Kane here. I've been in the housing industry for nearly 20 years. I own properties throughout Ontario. Watch my full biography video to see my story. Today, I'll show you 3 practical moves you can make depending on which path rates take. Here's what happens at 9:45 a.m. on September 17th when the Bank of Canada makes their announcement. At 8 a.m., journalists are shown the press release under embargo at the bank's head office in Ottawa. They can't communicate with anyone until exactly 9:45 a.m. when the embargo lifts and everything goes public. After that, Governor Tiff Macklem holds a press conference to explain the decision. This structured process happens 8 times a year on set dates. A recent Reuters poll showed 25 of 32 economists expecting a 25 basis point cut to 2.50%. That's a strong majority. But there's more to this story than just one cut. The unemployment rate hit 7.0% in August 2025. That's the highest in 9 years outside of pandemic periods. When unemployment jumps like this, it creates pressure for the bank to act fast. People without jobs don't spend money. When people don't spend, the economy slows down. This isn't just about one meeting. It's about a pattern that started when rates peaked around 5.00% in mid-2024. Following that peak, the BOC has cut by roughly 225 basis points to reach today's 2.75%. Each cut was 25 basis points spread across more than a year. The bank held rates steady in April, June, and July 2025. They were watching the data. They wanted to see if their previous cuts were working. But now, the economic data is forcing their hand. The labor market is weakening faster than they expected. Companies are laying off workers. New job creation is slowing down. These are the warning signs that recession might be coming. The BOC's primary job is to keep inflation near 2%. Labor market weakness is a major input that pushes them toward easing. Core inflation is still sitting around 3.0%. That's above their 2% target. This creates a tricky balance for the bank. They want to cut rates to help the economy and unemployed workers, but they also don't want inflation to get worse. Higher inflation hurts everyone because everything costs more. Food, gas, housing, all of it gets more expensive when inflation runs hot. The bank looks at different types of inflation data. Core inflation strips out food and energy prices because they move around a lot. The bank focuses on core inflation for their long-term decisions, but they also watch headline inflation because that's what people see in stores. Both types of inflation matter for different reasons. Here's where economists split on deeper cuts. Some think inflation will keep falling on its own. They point to weaker demand and slower wage growth. When people have less money to spend, prices usually come down. These economists think the bank can cut rates without worrying too much about inflation. They see the unemployment problem as bigger than the inflation problem right now. Other economists worry about external shocks, things like oil price spikes or supply chain problems. These can push inflation back up quickly. They think the bank should be more careful about cutting rates too fast. If inflation jumps back up, the bank would need to raise rates again. That would hurt the economy even more. The split also comes down to timing. Everyone agrees rates will probably go lower. The question is, how fast and how much? Some think we'll see rates at 2.00% by the end of 2025. Others think the bank will move slowly and only get to 2.25% or 2.50% by year-end. The difference might seem small, but it's huge for mortgage payments and investment decisions. Currency markets are already pricing in rate cuts. The Canadian dollar has been weakening against the US dollar. When rates drop, foreign investors pull money out of Canadian bonds and investments. This makes our dollar worth less compared to other countries. But the market forecasts aren't as clear-cut as they used to be. There's something creating unusual uncertainty in these predictions. Global tariffs represent the biggest wild card in these rate predictions. The bank itself highlighted tariff unpredictability as a key reason for its cautious stance on future policy direction. Trade wars and tariff battles between major countries create ripple effects that hit Canada's economy in ways most people don't expect. Tariffs create cost-push inflation by making imports more expensive as businesses pass these costs on to consumers. At the same time, tariffs can weaken demand for Canadian exports like lumber, oil, and wheat, hurting growth and employment in these key industries. This forces central banks into impossible situations where they must choose between fighting inflation and supporting economic growth. Central banks sometimes avoid a strict rate response to cost-push inflation because higher borrowing costs can worsen growth. The Bank of Canada faces exactly this dilemma. Normal economic theory says you raise rates when inflation is high, but if tariffs are causing both inflation and economic weakness at the same time, the bank faces a tough choice. Do they fight inflation with higher rates and make the recession worse? Or do they cut rates to help the economy and let inflation run higher? Most central banks choose to help the economy in this situation. They figure that tariff-driven inflation is temporary. Once trade disputes get resolved, those price increases should reverse. But the damage to employment and business confidence can last much longer. People who lose their jobs don't get them back right away when tariffs get removed. Tariff-driven inflation can squeeze consumer budgets and weaken exporters, meaning the BOC might cut to support jobs even while headline prices stay sticky. Some analysts think tariff-driven economic weakness could push rates all the way down to 2.00% by the end of 2025. This would happen if global trade tensions get worse and hurt Canada's export industries. Mining companies, forestry companies, and energy companies employ millions of Canadians. If these industries struggle because of global trade problems, unemployment could jump much higher than that 7.0% we're seeing now. The Canadian dollar also plays a role here. When rates drop, our dollar typically weakens against the US dollar. This happens because foreign investors can get better returns in US bonds and investments when their rates are higher than ours. Money flows out of Canada and into the US. If rates fall and the dollar weakens, imports cost more. That can reduce the net benefit of lower mortgage payments. The currency effect gets worse with tariffs. If other countries put tariffs on Canadian exports, demand for Canadian dollars drops even more. Foreign companies need Canadian dollars to buy our lumber and oil. When they buy less of our stuff, they need fewer Canadian dollars. This pushes our currency down further. The Bank of Canada can't predict what other countries will do with their tariff policies. They have to wait and react to events as they happen. The National Bank noted that 36% of businesses have already been affected by trade conflicts, experiencing price increases, changes in demand, or supply chain disruptions. This shows tariffs are having real impact on the Canadian economy right now. The market is pricing in this uncertainty, which is why forecasts range from 2.00% to 2.50% by year-end instead of a clear consensus. Nobody knows how bad the trade situation will get. This uncertainty creates both risk and opportunity for real estate investors. Properties might become cheaper if rates drop to 2.00%, but higher import costs could push up construction costs at the same time. The key is understanding how these forces work together instead of looking at interest rates alone. But waiting for the bank's announcements puts you behind the curve. There are signals you can track right now that show where rates are heading before the official decisions get made. Most people wait for rate announcements to make decisions, but smart investors are already reading the signals months ahead. They watch the data that the Bank of Canada uses to make their decisions. This gives them weeks or even months of advance notice before rate changes happen. The trick is knowing which signals matter most and how to read them correctly. There are specific indicators you can track to predict rate movements before they happen. The bond market often moves weeks before the Bank of Canada announces anything, and monthly employment reports are one of the key readings the BOC watches. These signals give you a huge advantage over investors who only react to news headlines. You can position yourself before the crowd catches on. Watch the 5-year Government of Canada bond yield. This is the most important signal for mortgage rates. When this yield drops, fixed mortgage rates usually follow within days. Banks use this bond yield to price their mortgages. If you see the 5-year yield falling from 3.2% to 2.9%, you know fixed rates will drop soon. This happens because banks buy these bonds to fund their mortgages. When bond prices go up and yields go down, Banks can offer lower mortgage rates and still make money. You can check the 5-year bond yield every day on the Bank of Canada website. It updates in real time during trading hours. When you see it moving down for several days in a row, the bond market is telling you what smart money thinks will happen next. Monthly employment reports are one of the key readings the BOC watches and show you the trend before the bank reacts. That 7.0% unemployment rate didn't surprise anyone watching the data. The trend was clear for months before it hit that level. In February 2025, unemployment was 6.4%. By March, it was 6.6%. April brought it to 6.8%. May hit 7.0%. Anyone tracking this data saw the bank would need to act. You can also watch weekly claims for employment insurance. This data comes out faster and gives you early warning signs. When more people file for employment insurance, it means layoffs are increasing. The bank watches this data closely because inflation is the core mandate, but labor market data helps shape decisions. The bank's own language in their statements gives you clues about their next move. Words like data-dependent and balanced approach tell you they're ready to move rates in either direction. When they say gradual approach, it means slow changes. When they say appropriate to act more quickly, it means bigger rate cuts are coming. Pay attention to how the governor talks about inflation versus employment. If he spends more time talking about job losses than price increases, rate cuts are coming. If he focuses on inflation risks, they might hold rates steady or even raise them. The governor's press conferences after each meeting give you these clues. Currency markets also give you early signals. When the Canadian dollar starts weakening, it often means rate cuts are coming. Foreign investors sell Canadian bonds when they expect lower rates. This reduces demand for Canadian dollars and makes our currency weaker. You can track the Canadian dollar versus the US dollar on any financial website. For new construction purchases, you can use rate expectations to time your deposits and lock in financing during the build period. If signals point to lower rates in 6 months, you might wait to lock in your mortgage rate. But if signals show rates might go up, lock in your rate early. Construction projects take 12 to 24 months, so timing matters for your final mortgage. If the 5-year yield is falling for several days, monthly employment is weakening, and the bank's statement language shifts toward ready to ease, that combination often precedes cuts. When all 3 signals point the same direction, you can be confident about the next rate move. When they conflict, it means uncertainty, and you should wait for clearer signals. The September 17th decision will give you one data point, but the real advantage comes from tracking these patterns over time. Understanding these patterns gives you 3 concrete moves you can make right now. If you expect deeper cuts to 2.00%, consider variable rate mortgages because they fall immediately with prime when the bank cuts. If you expect moderate cuts to 2.25% or 2.50%, lock in a short-term fixed rate or discuss rate hold options with a broker. If you expect rates to hold steady, shop brokers for better spreads now and consider rate hold products during pre-construction builds. Remember that fixed rates follow bond yields, while variable rates follow prime tied to the BOC rate. This is why tracking both bond yields and bank language matters for your mortgage decisions. Tariff-driven uncertainty creates multiple plausible rate paths, but you can prepare for each scenario using these 3 planning moves while watching bond, labor, and BOC signals. If you like this content, be sure to watch my next video on Canada's inflation. Do you have enough to retire these days?